Have you ever noticed how people casually say things like, "Yeah, my car payment is only $650 a month," as if that's completely normal? Some people are paying $700, $800, even over $1,000 every single month just to drive a car that keeps losing value the second it leaves the lot. And somehow society convinced us that this is just what adults do. But here's the truth. Normal doesn't always mean smart. In fact, one of the fastest ways Americans stay broke is by locking themselves into massive car payments that quietly steal their future wealth. What makes this worse is that most people never realize they were sold a payment, not a car. And once you understand how dealerships structure these deals, you'll never walk into a showroom the same way again. Today, I'm breaking down the exact tricks dealerships used, how buyers accidentally overpay by thousands, and how financially smart people turn vehicles into strategic assets instead of monthly burdens. If you're serious about building wealth while still driving something nice, stay with me because this could save you tens of thousands of dollars over your lifetime. Let's get into it. The first trap starts before you even look at the car. The salesperson walks over, smiles, shakes your hand, and asks, "What monthly payment are you comfortable with?" This sounds innocent, but this is one of the biggest traps in auto financing, because the moment you answer with something like, "I want to stay under $600, you've already given away your leverage. Now they no longer need to sell you. Based on the price of the car, they only need to make the numbers feel acceptable. This is dangerous because almost nobody stops to calculate what that monthly payment really means. Over 72 or even 84 months, a $650 payment might sound manageable. But over 7 years, that's more than $54,000. And many people are making these payments on cars worth far less than that. This is how people become upside down financially, without realizing it. The focus should always be total purchase, price at idle interest, paid loan, term actual market, value depreciation, curve, and not just the monthly number. The monthly number is where dealerships hide profit. Here's another thing most buyers never think about. The dealership often makes money from the interest rate spread. Let's say the lender approves you for 5.5%. The finance office may present it as 7.5%. That difference can generate additional back-end profit. So many people assume the dealership is simply helping them get financing. In reality, financing is often one of the most profitable parts of the entire transaction. That's why the finance office feels like a second sales room, because it is. This is where people get sold. Extended warranties, JP coverage, catch plants will insurance incident, repair key, replacement triplet service. Some of these products can be useful, but the problem is they're often bundled into the monthly payment so smoothly that buyers never notice how much they actually cost. An extra $2,500 doesn't feel painful when it's hidden inside. 84 months. That's why you must always ask for the out-the-door price, not the payment, the real total. Now let's talk about the biggest wealth killer, buying brand new cars too often. A brand new vehicle usually takes its hardest depreciation hit in the first 24 months. That means someone buying new is paying premium pricing for the steepest loss period. Financially smart buyers often let someone else absorb that first depreciation wave. The sweet spot is usually a 2 to 3-year-old certified pre-owned vehicle. Why? Because you often get lower price motor and features warranty, protections lower, depreciation burden, value retention. This gives you the feeling of driving something high quality without taking the largest financial hit. That's how smart money still enjoys nice things without burning cash. Now here's where wealthy thinking changes everything. Rich people don't just ask, "Can I afford this payment?" They ask, "How does this purchase affect my balance sheet?" That's a completely different mindset. A car in your personal life is usually a depreciating expense, but when used strategically inside a real business, transportation can become part of operational infrastructure. This may open the door to legitimate deductions for business-related use. Depending on your local tax laws and actual business activity, examples may include millage. Keyword is legitimate. This is not about pretending your luxury SUV is a business truck. This only works when the vehicle genuinely supports income-producing activity. For example, real estate showings, client meetings, delivery operations, media, production assistance sticks, travel field service businesses. The wealthy think in systems. If the vehicle supports revenue, it may fit into the business system. That's very different from financing a status symbol personally. Now let's talk about leasing. A lot of people love leasing because it gives them lower monthly payments and a new car every few years. But leasing can quietly become a permanent subscription to depreciation. You never build ownership, you're paying for usage. And once the term ends, you either return it, pay penalties, lease again, buy it at residual value. This cycle can keep people in non-stop payments for years. Then come the hidden costs. Excess maligatir work, cosmetic damage, damage disposition, feast or nin, inspections even. Responsible drivers get surprised by lease end bills. That's why many people feel trapped. Leasing isn't always bad. For some business cases, or very specific cash flow strategies, it can make sense. But for average consumers chasing image, it often becomes a wealth leak. Here's the identity trap nobody talks about. A huge percentage of car purchases are emotional. People buy for how they want to be seen. Success, status, lifestyle, approval. But the truth is, the people who are actually building wealth usually prioritized cash flow investing, business growth tax, efficient certed liabilities, or upgrading lifestyle. That doesn't mean driving junk, it means buying smart. There's a huge difference. Yep, can absolutely drive a beautiful car. Just make sure it fits your financial ecosystem, not your ego. Here's a smarter framework. Before buying any car, ask these 5 questions. 1. What is the total cost over the full term? Ignore the monthly payment first. 2. What is the depreciation after 3 years? This determines true wealth loss. 3. Could certified pre-owned cut the cost dramatically? Usually yes. 4. Is this purchase delaying investing? Would this payment be better in index funds or your business? 5. Is this transportation or identity spending? This question changes everything. Imagine someone paying $800 a month. That's $9,600 a year. Over 5 years, that's $48,000. Now imagine that same money invested into diversified assets, retirement funds, or business growth. The opportunity cost becomes massive. This is why expensive car payments quietly delay wealth by years, sometimes decades. Now here's what financially smart buyers do instead. They separate the negotiation into 4 parts. Vehicle price financing, rate trade and add-ons dealerships. Want all 4 blended together, because confusion creates profit. Smart buyers isolate each one. Negotiate the vehicle first. Secure outside financing. Quotes, before walking in, know your trade-in value independently. Decline unnecessary add-ons. This forces transparency, and transparency saves money. Another overlooked move. Get pre-approved from your bank or credit union first. When you already know your approved rate, the dealership loses the ability to manipulate the financing conversation. This instantly puts you in a stronger position. Sometimes the dealership can beat your pre-approval. That's great, but now they must compete honestly. Let's talk about what wealthy people really optimize for. It's not just lower payments, it's cash flow efficiency. Smart buyer wants transportation that supports life and business while preserving as much capital as possible. For real estate testo sigil, business smart team, building growth emergency reserves. That's how people move from looking at rich to becoming rich. So if you currently have a large car payment, don't panic. This isn't about guilt, it's about awareness. Run the numbers today. Ask yourself, what's my interest rate? How much total interest remains? Am I upside down? Would refinancing help? Could I sell and step into a better value vehicle? Is this slowing down investing? Those questions create financial clarity. At the end of the day, the real flex isn't the newest car. It's owning assets to grow while you sleep. A car should support your life, not consume your future. The goal is not to look wealthy in the parking lot. The goal is to actually build wealth behind the scenes. That's the difference between normal and smart. And once you understand how the car payment game really works, you stop being the customer they profit from and start becoming the person who makes money decisions with power. If this helped you rethink your car payment strategy, this topic alone can change your financial future.